And we're back. Continue with our chapter 9 discussion on ratio analysis. We left off focus on a vertical analysis of an income statement where each line item, each number was shown as a percentage of our sales amount. So we're still going to take a look at year 3 against year 4, and we see that for both years, net income represents 2.8% of the sales in both year 3 and also in year 4. Okay, let's now look at the balance sheet. And so now notice that total assets is going to be our base number. You're showing each asset as a percentage of the total assets. So cash represents 3.9% of total assets, marketable security, 3.9%. So again, we're showing each asset as a percentage of the total assets in both year 3 as well as in year 4. And this is known as a vertical analysis. Okay, if we keep going, now we're going to look at the liabilities and equity section. And now we're using total liabilities and equity as our basis. So now we're saying that accounts payable represents 7.9% of our total liabilities and stockholders' equity, whereas retained earnings represents 31.9% of our total liabilities plus stockholders' equity. Okay. Now notice that for the current liabilities, this is those three amounts added all together. And the same would be for your current, for your long term. So liabilities represent 28.8% of total liabilities and equity, whereas stockholders' equity represent 71.2% of the total liabilities and stockholders' equity. So with a vertical analysis, you're comparing each line item as a percentage of a certain figure, such as your total assets or your total liabilities and owner's equity. So what is the objective of ratio analysis? Well, it shows the relationship between different items reported on the financial statements. So depending upon what type of decision you're going to make, there's certain information that's going to be more relevant or material than others. So for example, if you are a creditor, you're interested in whether a company can repay its debt on time. Creditor stockholders care how the company is going to be financed. Is there debt financing? Is there equity financing? If I am a stockholder or a potential investor, I'm concerned about the earnings performance and dividend policy for the company. So as you see, these different users want to look at different information about a company in order to make their decision. We're now looking at how to calculate what we call certain type of financial ratios. And each ratio will fall upon the normally one to three categories, what we call liquidity, solvency, or how profitable is that business organization. Okay, we'll first look at some liquidity ratios. The ratios focus on a company's ability to pay their short-term debt. So now, let's make this personal. Think about all of the items, your bills that you have due for the upcoming month. Think about the money that you have coming in for the upcoming month. So now we're saying, do you have the ability to take care of your short term obligations as those obligations are becoming due? We're saying, how liquid is this business organization? So there are 5 different rates we'll take a look at that focus on liquidity: the working capital ratio, the current ratio, the quick ratio, account receivable ratios, and inventory ratio are going to be our 5 categories. Okay? Let's begin with working capital. Well, what is working capital? It is the excess funds a company will have available for operations. So to compute your working capital, it is simply your current assets minus your current liabilities. So here we see the working capital for year 3 and for year 4. You will either have positive working capital, meaning your current asset exceed your current liabilities, or you will have negative working capital, meaning your current liabilities are more than your current asset. For this company, we see they do have positive working capital in both year 3 and year 4. It was 102,000 in year 3. It increased to 122,000 in year 4. Okay, but what does that mean? I'm glad you asked that question. It's saying that this company is liquid. They do have the ability to take care of their short-term obligations as those obligations are becoming due. Now, we'll take that same information and put it in a ratio format known as the current ratio. So write this down. The current ratio is current assets divided by current liability. Again, current assets divided by current liabilities. So now we have two different companies. They're probably going to be competitors of each other, and we're comparing for each company their current ratio. All right. First, we take a look at their working capital, which is simply current assets minus current liabilities, and they both have the same working capital, but the current ratio shows a little different story. The current ratio for the first company is 3.65 to 1. Compared to the second company, it is 1.32 to 1. So to get your current ratio, you would take your current assets and divide those by the current liabilities. So now, how do we interpret this current ratio? Well, this is saying for every $1 in current liabilities, they have in current assets $3.65. Compared to the other company, for every $1 in current liabilities, they have in current assets $1.32. So both companies are liquid. But the first company is a lot more liquid because they have more in current assets from a percentage standpoint to cover their current debts. Okay. So if I'm a creditor and I can only loan one company money, I would choose the first company because they're showing more of the ability to take care of their current obligation as those obligations become due. Okay. Another ratio of liquidity is called the quick ratio, which now we call our quick assets divided by current liabilities. So what does that mean? Well, quick assets says that there are certain type of current assets that cannot be used to pay off debt. Items such as prepaid items. So you got prepaid rent, prepaid insurance, that cannot be used to pay off debt. So with the quick ratio, we only include cash, receivables, and market securities. We do not include any inventory, nor do we include any type of prepaid expenses. So now let's see with the quick ratio, it may be a little tighter. So here with the current ratio, it was 3.65 to 1 in year 4, 3.37 to 1 year 3, which looks really good. But now let's dive a little bit more into the weeds, if you will. And we're taking away certain current assets, and we're only including pretty much those assets that are either in the form of cash already or that we can convert into cash in a relatively short period of time. So now the ratio goes down to 2.04 to 1, and 2.28 to 1. So we see that we're still pretty liquid, but when it comes to the quick ratio, which is a truer depiction of your ability to take care of your current obligations, we're not as strong as we thought by just looking at the current ratio. Okay? So companies want to collect receivables as quickly as possible without losing customers. So we'll take a look at some ratios that focus on how quickly we are converting the account receivable into cash. So our first ratio is called the account receivable turnover ratio. Again, the first ratio is called the account receivable turnover ratio. Okay? With this ratio, we're going to focus on the average amount of time it takes to collect on our receivables. Again, the average amount of time it takes to collect on our receivable. So again, write down this definition. The definition is the net credit sales, or the formula is net credit sales divided by your average account receivable. Again, net credit sales divided by the average account receivable is account receivable turnover. That ratio goes along with another ratio called the average days to collect receivable, which you take 365 days and divide it by the account receivable turnover. So the turnover really says how many collection periods are there within a year. Again, how many collection periods are there within a year? So I can tell you the more collection periods you have, the quicker you're going to collect on your receivable. So let's kind of take this information and put into some actual ratios. So here we're showing net sales. Let's look at year 4. We're showing net sales for year 4. This is our beginning receivable, and this is our ending receivable. To get your average receivables, you'll take your beginning receivables plus ending, add those together, divide that by 2 to get your average receivables. Again, it's your beginning receivables plus the ending, divide those by 2 to get your average receivable. And for this illustration, the average receivable will be 53,000 is the average amount receivable. To get your turnover, you'll take your net sales, 90,000, divided by the average receivables to get a turnover of 16.98 times in year 4 compared to 14.41 times in year 3. Now remember, the more time it turns over, oops, didn't give me another point of that, the quicker is going to be your days in receivable. So although I'm not showing it to you, to get the account receivable days in receivable, you would take 365 days and divide that, say, by the 16.98 in year 4, which give us 21.5 days. So we're saying in year 4, it takes about 21.5 days to collect my receivable. Compared to year 3, take 365, divide that by 14.41, and that would give us 25.3 days. So we see we're improving. We're collecting quicker in year 4 than what we did in year 3. And that's called the account receivable turnover and the average collection period. These next few ratios focus on inventory turnover, and the average days to sell inventory. These ratios focus on the length of time on average it takes to sell an item in inventory. So we're going to come back and continue working on some ratios, beginning with our inventory ratios. Okay? Stay tuned.